A zero wash, zero cost loan? Sound too good to be true? It isn't. In this episode, I'm going to teach you reason number 3 out of 5 to borrow money instead of withdraw money out of an IUL policy. By the end of this episode, you will understand what a zero cost or zero wash loan is and how they work. So my name's Doug Andrew. I've been a financial strategist, retirement planning specialist for more than 48 years, helping people to be able to prepare for a comfortable retirement and achieve other long-term goals. And it's more than just the money. If you look at this channel, Three-Dimensional Wealth, only one dimension has to do with money. But this episode, we'll talk about one of my favorite financial instruments that allows you to accumulate, access, and transfer your money totally income tax free. And you have to simply follow the rules to be able to make sure that all the income you ever take out, if you're retired age 65 and you live to be 120, is totally tax free. The IRS will know you're receiving it, and they'll know it's not even worth auditing because it's been a sacred tax-free cash cow in the Internal Revenue Code for over 108 years. Okay, so as we proceed here, get ready, because I'm going to gift you a copy of my most recent best-selling book at the end of this episode. But my favorite vehicle I call the Laser Fund. And the book I'm going to gift you is called the Laser Fund. It's 300 pages, and it's been flying off of our warehouse shelves. But LASER is an acronym that stands for Liquid Assets, Safely Earning Returns. What is a Laser Fund? It is a properly structured, maximum funded, indexed universal life insurance policy. And people go, what? I've never seen an insurance policy that has a very good rate of return. Well, then you haven't seen one done correctly, because I have earned average rates of return of 9.62% on mine since 1997. And there are some years, like 2017, thousands of people who have indexed universal life were able to earn 25%. In 2021, because of COVID-19, many people earned 61.33% and even 153% tax-free on their indexed universal life. Yep, we have one client that started out in the year 2020, March of 2020, when the market dropped 30%, that with the indexed universal life, he had a balance in March of 2020 of $850,000. It was a little bit more than that. But a year later, he had a balance of $1,382,000. He made over $500,000 tax-free in his indexed universal life policy. And there are naysayers out there that say, oh, I've never seen one do that. They don't even know what they're talking about. This is my favorite instrument to be able to not only accumulate money tax-free, but when you retire, and you don't have to wait till you're, older than age 59 and a half to retire. That's why I don't like traditional IRAs and 401ks, because you're going to have to pay tax on them, and it's subject to market volatility. Indexing means you get to participate when the market goes up and you don't lose when the market goes down. And so you want to watch other episodes on this channel to understand indexing. But in this episode, I'm talking about reason number 3 why you want to borrow money instead of withdraw money when you need to access money out of an IUL policy. When you borrow, in the second reason episode, I talk about it's a phantom loan. It's not due and payable during your lifetime. So let me just make sure you understand that. Let's say that you have $1 million accumulated, and it doesn't matter if you have 100,000 or 10 million, but if you have $1 million accumulated, and if you're able to pull out 10% a year, which many of our clients do, they can take out 100,000 a year without depleting principal because of the indexing and because of what I'm going to teach you in this 5-episode series. $1 million, and at 10%, you want to pull out 100,000 a year, and it's tax-free. Now, it's tax-free even if you withdraw it, until you've recovered your basis, what you paid in. But after that, if you kept withdrawing your money, you would trigger unnecessary tax. That's dumb. You want to do it the smart way, and the IRS actually says, if you'll just borrow the equivalent of your interest from the insurance company, you won't have to pay tax, because loan proceeds are not deemed earned passive or portfolio income. It's been that way for years. If I have $1 million in there and it's earning 10%, and I borrow $100,000 from the insurance company, and they have my million as collateral, and it's earning 10%, then I'm not withdrawing. So my million is going to grow to $1,100,000 at the end of that year, and my $100,000 loan is subtracted from the $1,100,000 at the end of the year, and my net is $1 million, which I would have had I pulled it out in the dumb way and paid tax on that $100,000. But by borrowing, I don't have to pay tax on that income. So far, so good. Now, the IRS says in order to have it be a true loan, the insurance company has to charge at least a minimum statutory interest rate. So that's been about 2% the last several years. So the insurance company is charging you 2% interest on the loan. So you're pulling out $100,000 a year for retirement income. It's tax-free because it's a loan proceed, and they're charging you 2% interest on $100,000. The next year it's $200,000 plus the interest, and then $300,000. But over here, your million is growing to $1,000,001, $1,000,002, $1,000,003, and it's being credited with the same interest rate. The collateral that's collateralizing the loan is the same 2%. That's called a zero wash or zero cost loan. So it doesn't cost you anything to call it a loan. The IRS knows you're receiving it, but they say if you'll do it that way, it's tax-free. So that's called a zero cost or zero wash loan. And they deem it a true loan because the insurance company is charging you interest on a ledger. That loan is not due and payable during your lifetime, as I explain in reason number 2. Okay? It's washed away down the road when you die. But you have this phantom loan balance, and it's offset by this cash value balance, and this minus this equals the same amount of money, $1 million, if you're just living off of the interest, and it's tax-free. And so the magic behind it is you are simply using what the IRS says in order to have tax-free income, because it's not deemed earned passive or portfolio income. It's that simple. This is not a loophole. People sometimes say, oh, when the IRS finds this out, they'll close that loophole. They're the ones who basically dictate the rules. Okay, this is not a secret. It is to a lot of financial advisors. So, if this is intriguing you, I would recommend, first of all, subscribe to this channel. It's free. Click on subscribe and click that little bell, because then you'll be notified every time I post a new episode, which I do almost on a daily basis. I don't want you to miss out. This is about you and your brighter future. It's not about me. I'm 70. And no, I don't color my hair, but I've made a lot of mistakes in my life. I don't want you to make the same mistakes. I want you to learn from mine. And so that's why I do this. And I have over 730 episodes on this channel as of the recording of this episode, to not go to my grave with all this wisdom still trapped in me. And that's why I have this channel. This is about you. It's not about me. And so be sure and subscribe and click like or post a comment and share it with somebody who would benefit. So let's connect the dots. The IRS does not deem money that is borrowed as income, whether you borrow for a house, you borrow for a car, or you borrow money out of your insurance policy. Why would the insurance company loan you money? Because they have your money. A bank would do that. If you had $1 million in the bank and you said, well, I can withdraw $1 million, or I want to borrow $1 million and leave my money there. Oh, they'll loan you $1 million because they have your collateral. But with a bank, they only are crediting you 1%, and then they're charging you 5% to loan you money. With the insurance company, it's almost the opposite. Okay? When you borrow money out of the insurance company, they'll loan you the money and charge you 2%, and they'll credit you 2%, so it's called a zero wash loan. But I want you to watch the next reason, number 4 out of 5 reasons, to see how savvy, smart people do it. And they actually ask the insurance company to charge them a little bit higher interest, because then they can earn 10, 15, 20%. And this is called arbitrage. It's going to blow you away. So by following IRS guidelines, all income is tax-free, and it doesn't have to cost you anything. The loan is not due and payable during your lifetime. It says zero wash or zero cost loan if they charge you 2% and they credit you 2% in this example. Is this piquing your interest? You don't know the rest of it. You're seeing the tip of the iceberg. Here's how you can claim a copy of my book, The Laser Fund. So this has been flying off of our warehouse shelves. We send out 100 to 700 of these a week. Don't miss out. You simply go to laserfund, LESERfund.com. Click on the link below. You contribute a nominal amount towards the shipping and handling. Have some skin in the game, then you'll appreciate it and read it. I'll cover the rest of that cost and I'll pay for the book. It retails, on Amazon for $20. No, I'll pay for the book. I'll fire out a hard copy to you. There's options there to listen and learn, watch and learn. This is 2 books in one. This side is 200 pages, 14 chapters with all the charts and graphs for the left brain thinker. If you're a right brain learner or thinker, you flip it over and read this one. This is 100 pages, 12 chapters with 62 actual client stories. But if you want to use your whole brain, I would read both of these books, okay? This is about your brighter future, and you will learn how to take money out of an IUL policy the smart way by using loans instead of withdrawing money. And search the other episodes on this channel because I want you to understand all 5 reasons why you should borrow instead of withdraw money out of your laser fund.